Welcome to the Earn Your Marks podcast, presented by Pro Exam Tutors, the only podcast you need to pass the CFP exam and become a certified financial planner professional. Here's your host, Sev Meneshian.
Welcome to the Earn Your Marks podcast. I'm Sev Meneshian, certified financial planner practitioner, lead tutor, and the founder of Pro Exam Tutors. Now, in this episode, I'm going to talk about the investments module of your curriculum and some of the topics that a lot of students struggle with, such as options and bonds, bond duration, trainer, Sharp, Cap M, just to name a few. But speaking of bonds, I figured we could start with talking about some of the risks that bond holders are exposed to, along with some of the tax consequences that they should be aware of, and you should be aware of, obviously, as a practitioner and a CFP exam candidate. And I figured we'd start there because I know that nothing fires you guys up more than bonds and taxes. Like, those are the two primo areas of the exam that everybody loves, that and health insurance. But if we look at the bond terminology, let's just start there for a second. We've got the bond risks, of course, that we have to be mindful of. These are like your prime risks, your DRIP risks, default risk, interest rate, reinvestment rate risk, purchasing power risk. So we want to know, those things, how they're impacting the decisions of our bond investors, or let's just say of our investors in general, because we know that most investors have some mix of stocks and bonds in their portfolios. Now, there are other things too, like precious metals or natural resources, but we're not going to really focus too much on those things. So, but to start off with, knowing your bond risks are a big thing. Purchasing power risk, we've seen that at least recently in the last couple years in our markets. With the reinvestment rate risk, that's something that bond holders right now, as I'm making this recording, that's something that bond investors are, let's say, cognizant of, because with falling interest rates, what you're going to be exposed to is reinvestment rate risk. Okay, and the bond was issued at 7%, at a 7% coupon. Now the market itself is yielding, around 5%. So now when I'm getting my coupon payments of $70 per year, in theory, I'm reinvesting that $70, but now I'm doing it and I'm reinvesting, but I'm only getting 5%. So that's an example of your reinvestment rate risk. Okay. Now, there are other areas within bonds, like duration is one of them. How do we, what is duration? What does it have to do with maturity? Well, there's a lot there. You have your modified and you have your Macaulay duration. So we're going to want to know the difference between the two of those. But we do want to match the time horizon of our client, or we want to match duration to the time horizon. So classic, probably question on the CFP exam. Of course, I don't know what they're going to ask, but I can see a classic question being something like, you've got a 40-year-old, 45-year-old client. He's going to retire in 20 years. He's going to hand over to you $1 million to invest in a bond portfolio specifically. And the question, it might look like the answers are not concise. In fact, they might not be. This just might be a type of question where we're not going to have like a concise answer. We're going to have to take a very, very educated guess as far as what the right answer is. Now, that's not meant to scare you off, because if you know what they're asking as far as the duration and then the time horizon of the investor, my sense is that they're going to give you basically one, obviously they're going to give you like the most correct answer. They could give you a couple answers that, that could be right, but we want to nail down, obviously, the one that is the most correct. So how are they going to set you up for this type of question? Well, going back to our 45-year-old guy hands over $1 million in treasuries to you. Grady's handed that over and he tells you, look, I'm going to retire in 20 years. How are we going to set up that? How are we going to set up that investment or that bond portfolio? And I'll tell you, the way that we're going to do it is we're going to put you into a diversified bond portfolio. We're going to have some maturities that are like 30 years. We'll have other maturities that are like 25. Will we have any maturities on these bonds in that bond portfolio that are 20 years? Maybe, if there's zero coupon bonds. But what I'm getting at here is if somebody says that they're going to retire in 20 years, the duration of that bond portfolio must also be 20 years. Not the maturity of the average maturity of that bond portfolio, it's the duration. Okay, so when I was talking about the board potentially giving you like a almost like an inexact answer to choose from, what I mean there is that they'll say something like the advisor or the CFP practitioner would be best suited to place the client into a bond portfolio with a maturity of 23 years, for example, or it might say like 22 and a half years or 23 and a half years, some odd number. So what they're saying is, now the interpretation there is that the bond duration, when we have a coupon paying bonds, the actual duration, the average, the time-weighted amount of time that it takes for us to actually recoup my investment on a 20-year bond is actually like 18 years, or on a 23-year maturity bond portfolio. Okay, the duration might be actually like 20 years. And why is that? If these are coupon paying bonds, I start recovering my principal or my investment the moment that I start getting that initial coupon payment 6 months after I buy that bond portfolio. Okay, so duration obviously is like one area that we're really going to have to pay attention to. They could ask you also, okay, if interest rates go up, well, how far is this bond going to fall in price? And there are a couple formulas on your formula sheet that you can immediately go to. But what you might want to do instead is just use this little trick. Now, if you're just listening, you won't say this. Or you won't see this, but I'm going to try to illustrate this for you guys or explain it the best that I can if you're not watching this. If you're not watching the video, but very easily or very simply, if we have interest rates that go up, let's say IR, so we've got an arrow pointing up and interest rates next to that, indicating if interest rates go up, we know that bond prices most definitely have to go down. So let's say we'll put the down arrow and then bond prices. Okay, so we definitely know that. Now, the little shortcut here is that if for every 1%, increase in interest rates, your bond price is going to fall by 1% as well, right? Times the number of years of duration. So what does that look like? Well, they might give you an example of, and actually on my exam readiness assessment, I have a question where you can actually use the shortcut. So if you want to take a look at this example or a question, go to the website proexamtutors.com and take the initial exam readiness assessment, and then what you'll find is this is a question that is asked on that assessment. It's only 20 questions, but anyway, if the question says something like, this bond price is at like, just make it up, I don't know, $950, and it's paying a coupon of 8%, and then the duration is like 3 years or something. Just make that up. What we're going to do, what they're next going to say is that, okay, well, the coupon is at 8, but changes in the market Interest rates have fallen by 0.5%. So let's say interest rates fall by 0.5%. How much does the bond price move up or down? Well, maybe two of the answers that they give you, or one of the answers, is that the bond price is going to go down. We can just scratch that immediately. It's nonsense. Bond prices and interest rates go opposite of each other. So now we're left with three answers. And, I've got 2 minutes per question to answer this. If I can take a little bit of a shortcut, though, like this one I'm going to show you here in a second, maybe that cuts out 1.5 minutes, and now I can add that to my time bank. Okay, if the answers that I am presented with are a little bit too compressed, like the answers are a little bit too close to each other as far as the numbers are concerned, then I can reach to my formula sheet and then do one of the bond duration calculations. But if we can save some time, we're going to do that. We'll do that right now. So we got a bond at $950. It's an 8% coupon, and the duration that they are going to tell you is like 3 years. Now, interest rates have gone up. Let's just say interest rates have gone up by 1%. That means that my bond price is going to fall by 1% times the number of years of duration. So if I just do the math quickly here, is that if we've got 1% times the 3, then what this is telling us is that we have a 3% rise in the bond price. Okay, now that looks a little bit too easy, so let's just change this up a little bit. Okay, so if I say interest rates are going to rise by 0.5%, I'm going to expect the bond price to fall by 0.5% times my years of duration, times 3 years. So that's a 1.5. So now I should expect this bond price to roughly go up about 1.5%. Okay. That's fine. It's going to get us close that'll get us close to the answer. Understand that using this shortcut will be like a little bit less than the true accurate answer. That's what I was saying before. If you can get away with using this shortcut, obviously go for it and save yourself the time if you're comfortable with it. And if you want to double check, or maybe you flag this for review, so answer it with the shortcut and you move on. And then if you've got time at the end of your segment, then you can go back and double check it with the calculation. Okay. So that's all we have for a little bit on the bond stuff. Another topic that gives you guys a hard time are options, which I can understand. They can be a little bit tricky. But what I'm going to illustrate for you, especially if you're really struggling with the options concepts, okay, get this part down fundamentally, and everything else is going to become a lot easier for you. So all I want you guys to do, and again, if you're just listening, I'm going to explain this the best that I can. If we have in, let's say, a quadrant, so if we just draw a box and we've got our four zones in there, I think it's explained that way depending on your book. Whoever your test provider is, I'm going to basically be drawing the same thing. I like the idea of just drawing a straight horizontal line, for those of you watching or seeing that. And then we're going to put let's put in green in the upper left corner. We're just going to put off to the side. This is like we're buying here. Okay, so if I buy a call, I expect the price of that security or that market, whatever it is I'm buying with a call on, I'm expecting it to go up. It's as simple as that. If I'm buying a put, I'm expecting the price of this security, ETF, stock, whatever it happens to be, I'm expecting it to go down. Okay, so that's when I'm in my buying mode. Now I can kind of get a little bit more advanced as I do more options trading. So let's say under the buy on the on the lower part or the under part of this horizontal line I've drawn, we're going to put a sell over here. So we're going to sell a call. You'll notice it's exactly the opposite of what buying a call is all about. And I know that sounds very basic, but I think that now let's just put a put here. If I'm selling a put, I'm expecting things to go up. Okay, now if I find somebody who is willing to pay me for the right to have the right to obligate me to sell the position or buy the position from them, then that's the engagement I got into, and I gotta play ball, obviously. All right, but if you look at this very fundamental graph here of calls and put options, you can just on that top line, we're buying a call, we think prices are going up, or I'm buying a put, I think prices are going down, and I want to put my stock to somebody who thought that the market was going up. Right? I happen to think that the market or this stock is going down. I want to protect my profit because I bought, McDonald's stock at 200 and now it's going down. I think it's going to go down to 150 and I want to like get out of this thing at $180. So I'll buy a put and I'll buy the right. And I'll force somebody to buy this thing from me. Okay, now McDonald's falls all the way down to $2 a share, which I don't think will happen anytime soon, but let's say it does. I'm sitting there fat and happy because I make that counterparty buy that stock from me at a McDonald's stock at $180. So now if you go to the sell side of things, everything is obviously it's opposite. So if I sell a call, I'm bearish on things. Okay, somebody's buying a call, they're bullish on things. So I'm going to let's just say if I had a crystal ball, I'll take advantage of that person. I'll sell them calls all day long. If I'm going to sell a put, then I'm bullish on things, and I've got on the other end of things, I've got a bear. This guy's buying a put because he's expecting things to go down, and he wants downside protection. Okay, so as far as like options are concerned, I know you can get really carried away with their complexity. So now, what I would do to augment your training or your studying too, don't be afraid to poke around sites like Yahoo Finance or listen to he's one of the Nigerian brothers. I think they're both options traders and they used to be on the financial shows. I don't know if they are anymore, but you can pick things up from them just listening in the background. Podcasts like this are a good idea, but it's always great to get different opinions or different angles of to get different inputs and different angles on topics. Right. If we go to geometric and arithmetic means, arithmetic mean, we're not going to spend really any time on that one, but if we look at like geometric mean, that does tend to trip you guys up a little bit, and I don't think it's anything that you'd have a problem overcoming, let's say, but you'll get a question that looks something like, let me look through my examples here. Let's take a look at, let's look at our geometric mean for a moment. I can't find it in time, so I'm just going to make something else, make something up here. But what on your practice questions, you'll see something like, Julie is investing, and she comes to you with these returns, and she wants to know what the geometric mean is of her past returns over the past 5 years. And that's pretty easy if they say, hey, Julie started out with 100,000 and now the thing is worth 200,000 and she started this investing 5 years ago. What's her compounded annual growth rate? And you can just look at it and say, it's close to 20% a year. I don't know, 18% per year. And you would be giving the geometric mean as the return in that example. But of course, that's not going to be that simple. So, but you could see something like, year one, Julie got a 25% return. And then in year two, it was like 13%. Then year three, unfortunately, we lost some money there. Okay, so she lost like 8%. And the following year, things came back and she was up like 10%. And then in the last year, who knows? Maybe she lost another 2%. Okay. So, that's like all that they're going to give you for the most part. And so, and they'll give you the time frame and all that good stuff. So if we just reach for our calculator, the way that you're going to do this, I mean, and I should say also, um, we can use really any starting figure that we want. You can use $1 or $100 or $100,000. It doesn't. You can use $43.12. I don't care. Let's just plot out though how we're going to handle this. And so we're going to go beginning/end. And usually we want to be in the end mode. And then we're going to write out our calculator time value of money keys here. Here's our payment and then future value. Okay, so beginning/end, where should we be? Most of the time we're in the end mode. We want to just confirm that. I do that still. I mean, I've been teaching this stuff for a million years, and I still do this. And why do I still use this little technique of putting a B/E with a little question mark? Why? Because it reminds me that I've got to check before I do any calculation whether I'm in the right mode, beginning or end mode. And by doing so, it forces me to look at my calculator. And when I look down at my calculator, guess what mode I'm in? I'm in the begin mode. I got to change that, obviously. Okay, that would have maybe thrown our answer off. But let's just work left to right. If they're telling us we've got 5 years, and I'm trying to figure out what this annual return is over here. We don't know. That's the big mystery. Present value, whatever you want it to be. I started with $1. We'll put that as a -1. We've got no payments in here, so we can just leave that blank. And then, let's see what our future value comes out to be, and then we can figure out what this compounded annual growth rate is. Now, the way that you're going to do this, if this is giving you trouble, is you say, in year 1, Julie made 25%. Okay, then she's got in her pocket $1.25. The next year, she makes 13%. So we're going to take a $1.25 times 1.13. What do we come up with? Now she's got $1.41. Let's just round it. I know we want to use 4 decimal points all the time, so I'm just going to shorten it down to 2 though. Okay, now she's losing in the third year 8%. So how do we deal with that? Well, I'm just going to take 92% of my $1.41 times 0.92. Okay, so now we're at $1.2995, just call it $1.30. She makes 10% in that 4th year. So just increase this by 10%. Take $1.30, multiply it times 1.1. Okay, and we're going to come up with $1. Round this up. We come up to $1.43, and then we've got this final year, which she just got a little bit of a loss here. She lost 2%. So I'm happy enough taking 98% of $1.43 to come up with the right answer. And at the end of 5 years, she now has $1.40. She has $1.40. $1.40 is what she's left with. She started with 1. What's the compounded annual growth rate here? Our average annual rate of return. I don't know. I'm just going to ballpark it. It looks like it's going to be around 8% per year, but I know this is a compounded growth rate. I'll say her growth rate was, just as a guess, I don't know, annual return was 7.3%. Let's see if that actually works out here. Okay, so we've confirmed that we're in the end mode. We've got a 5-year period here. Our present value, we started with $1 as a cash outflow. Remember, we're sending that out into the investment world. So the calculator is looking at our checking account. It sees $1 escape. It sees 5 years later, $1.40 still come in. We'll put 0 for our payment. Let's put $1.40 for our future value. What's our average annual return? Okay, that was off, by a little bit. It comes out to be 6.96%. Let's just round it up to 7%. Okay, so if you're struggling with, let's just put 6.9610, or call it 7%. It's a little bit easier that way. Okay, so that's how, if the mystery here was how do we calculate our compounded annual growth rate, hopefully that solved that particular mystery. Okay. We did talk about the duration and the little shortcut there. But now the rest of the things in investment planning, obviously they're certainly not easy, but the things that you really want to be focused in on are, go back to the fundamentals. What is beta? What's standard deviation? CAPM, for sure, CAPM. What is that, capital asset pricing model? Is there another word for it? Yeah, the expected return. So on a quiz or an exam question, they might not say, hey, the CAPM for fund XYZ is 8%. They'll say the expected return is 8%. And if you don't know that CAPM is expected return, that could throw you off a little bit. I'm not saying you get the answer, the question incorrect, but it just might stop you, make you think for just a little bit. Okay, so all of those, your probability distributions and so on, those are going to be the things that we're really tuned into, and we've got to know very well. So there's a lot of stuff in investments, obviously. This is just really a drop in the bucket here today. We can spend, as we can spend weeks on this stuff. Okay. But hopefully that just helps out a little bit. There are tons of things that you guys have questions on. Obviously you want to send those over my way. I'd be happy to answer those questions for you. So as far as today's episode on investments, that's what I have for you. And just remember, studying is a significant commitment. So make sure that you're hitting those books. You're doing lots of practice questions. And if you haven't done so already, subscribe to our YouTube channel at Pro Exam Tutors for videos on other tips and topics. Okay. And if you find this information to be helpful, please let me know with a like and a comment. I always love hearing from you guys. And if you know somebody or like a study group that can benefit from this knowledge, please be kind and share this information with them. I'm sure they'll certainly appreciate it. Thanks and good luck.
Thanks for listening to this episode of the Earn Your Marks podcast. For more information or to get in touch, visit us at proexamtutors.com.